Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. Here is Laurie Bailey with EURUSD currency pair forecast. Let's have a look.
Following yesterday's FOMC meeting, the current rate was left unchanged, and the markets received a clear signal. The rate may also remain unchanged at the September meeting. Now, markets expect only one rate cut by the end of the year, as previously hinted at before the blackout period. The cut has simply been moved from September to December. The EURUSD pair is just half a step away from the target support, and consolidation below it would open the way toward 1.1266. However, the 1.1380 target might have been misidentified, and the price could now move into a correction from yesterday's low of 1.1401. In any case, the price is within the June 311 consolidation range, and a breakout above 1.1495 could set an alternative scenario in motion. The reason for this lies in the resilience of the stock market. S&P 500 futures have reversed upward and are already close to their historical highs as of July 28. On Friday, non-farm payrolls for July are forecast at 108,000 compared to 147,000 in June. A weak report could reverse the stock market, but weekly jobless claims remain optimistic. Therefore, anticipation of the labor market data is a valid reason for the euro to move sideways within the 1.1380 and 1495 range. On the 4-hour chart, the euro has sufficient room to consolidate below 1380. There is logic in this move to demonstrate resolve or readiness to meet moderately positive US employment data. If the price moves toward the upper boundary of the range, it would be a more subtle preparation for a dollar positive scenario, unloading the Marlin oscillator before a continuation of a decline. Such a correction would also be beneficial for the daily Marlin oscillator.
And now it's time for GBPUSD. Let's discuss it with Paulo Greco.
The average volatility of the GBPUSD pair over the last 5 trading days is 96 pips. For the pound-dollar pair, this figure is considered as moderate. Therefore, on Thursday, July 31, we expect movement within the range limited by 1.3185 and 1.3377. Long-term regression channel points upward, indicating a clear uptrend. The CCI technical indicator has twice entered the oversold zone, signaling a potential resumption of the bullish trend. A new wave of corrective movement has now begun. The GBPUSD currency pair has resumed a technical downward correction. However, in the medium term, Trump's policies will likely continue to put pressure on the dollar. Thus, long positions targeting 1.3550 and 3611 remain relevant, If the price is above the moving average line, it's a sign line on a graphic. If the price is below the moving average, short positions may be considered with targets at 1.3245 and 31.84, based purely on technical grounds. From time to time, the US dollar shows corrections, but for a trend-driving strengthening to occur, we would need genuine signs of the end of the global trade war, something that now appears unlikely.
That's all for today. See you online soon.